start with looking at the current assets that we have on our balance sheet. Now guys, as you can realize, the assets that I've listed down here, they are in decreasing order of liquidity. So you could say cash and cash equivalents, that's the most liquid asset that you have here. Then you have accounts receivable, less liquid. Inventory, prepaids, lesser. Then you are going to have investments, PP&E, intangible assets. So guys, as we go down, the liquidity reduces. Now first, let's start with looking at this most liquid asset, cash and cash equivalents. First we have cash. So cash would be the money, the currency that you have in your wallet or in your lockbox. So that's currency. Or it could be the demand deposits that you have with the bank. So you could say currency, that's your cash in hand. This is cash at bank. So demand deposits are basically money lying in your bank which you can withdraw at any time without any prior notice or penalty. Now, along with cash, I said cash and cash equivalents. So we are also looking at cash equivalents. So these are short-term, highly liquid investments which are very readily convertible to cash. So guys, there are two criteria which are perceived as a hard line definition for cash equivalents. So as you can understand, there's a thin line between cash equivalents and investments or marketable securities. So that's basically the line that you need to meet by meeting this two criteria. Number one, cash equivalents are readily convertible to cash. Number two, cash equivalents are so near to the maturity date that they present insignificant risk of changes in value because of changes in interest rates. In other words, you could say cash equivalents are those short-term, highly liquid investments where the original maturity is less than 3 months. Original maturity is less than or equal to 3 months. So number one, they are readily convertible to cash. Number two, they are very close to their maturity date, 3 months or less. So here you could have treasury bills. So you could have treasury bills, let's say 4-week treasury bills or 3-month treasuries. You could have commercial paper with original maturity of less than or equal to 3 months. You could have certain money market funds. There are certain criteria for these, but you could say money market funds are those funds which invest in these treasury bills, very short-term treasury bills, highly liquid and commercial paper. So again, you have some criteria there, but you could say these could be cash equivalents, commercial paper or money market funds. Also, certificates of deposits with bank less than 3 months or less than or equal to 3 months. That's like a deposit that you make with the bank, something like a fixed deposit for less than or equal to 3 months. Now, you not only include investments with an original maturity of less than 3 months, you also include investments which you bought when the remaining time to maturity was less than 3 months. So, time to maturity at purchase date is less than or equal to 3 months. So let's say if I have a treasury bill, a 6 month or let's say a year long, so 6 month or 1 year treasury bill. If you buy these treasury bills on issuance, that's not cash equivalents. But if you buy the treasury bill when the remaining time to maturity is 3 months or less, that's a cash equivalent. Or let's say treasury notes, better example. So you could have a 2-year, 3-year, 10-year treasury note. Now, if you buy these treasury notes at issuance, that's not cash equivalent. But if you buy a treasury note from the open market when the remaining time to maturity is 3 months or less, you can classify it as a cash equivalent. So guys, we've talked about cash and cash equivalents. The first item under current assets on a balance sheet, highly liquid. Now, few points that you want to remember here is what's not cash. So let's write that on the board here. What's not cash? Not cash or cash equivalents. So if you receive a post-dated check from one of your customers, that's not cash. So post-dated check, when you receive it, actually does not affect your financial accounts or financial reports. Only when the check becomes current does it become cash. So guys, if you realize when you receive a post-dated check, there is a memorandum entry passed, does not affect your financial accounts. It's not treated as cash. You could say, you received a post-dated check which could be deposited in bank 1 month after the balance sheet date. So that's not cash. That's not even cash equivalents, because in cash equivalents we're looking at short-term investments which mature. A check does not mature. So a post-dated check is neither cash nor cash equivalents. That's nothing on your balance sheet. It's just a memorandum entry that you pass. Non-sufficient fund check. So if you deposited one of the checks that you received from your customers and the check got dishonored, in that case, that would not be cash until you have redeposited the check, the non-sufficient fund check, and it has been cleared by the bank. Now, what's also not cash is restricted cash. So you have cash lying with you, but it's got restrictions, either legal or imposed internally by the management. So if you got legal restrictions on the cash you have, that's not cash and cash equivalents. It could be a current asset, it could be a non-current asset. Let's say you have a compensating balance arrangement with a bank where you have some cash lying with the bank and the bank has given you certain loans on that cash. Now that cash, you cannot take it out. That's legally restricted. That could be a current asset, but that's not a cash and cash equivalent. Now, when I'm looking at, let's say, cash which is lying in a foreign country but which is not transferable out of the country, again, that's not cash. It could be a current asset if I can take it out within the next 1 year, or even a non-current asset if it needs to lie there for more than 1 year. You could also have special cash funds which management has set aside for special uses. Let's say management has set up a bond sinking fund. So they have certain non-current liabilities, bonds, which are going to mature, let's say after 5 years, and the management sets up a bond sinking fund to meet that liability when it matures. Now cash is lying in the bond sinking fund, but that cash is restricted, and since it's for a non-current purpose, it's a non-current asset, not even a current asset. So guys, you need to understand that restricted cash is not included in cash and cash equivalents. One more thing, even when you issue out checks to your vendors, let's say you've written a check on a current date but you didn't mail it out to your customers, or sorry, to your vendors. So when you mail out checks, you've written down a check but you didn't mail it out to your vendor. Now the check is lying with you on the balance sheet date. In that case, you will not be reducing it from your cash. You will reduce it from your cash only when you mail out, when you send out the check, because that's when the vendor would have access to your cash. Until then, it's your cash. So guys, post-dated check, whether you received it or given out, does not affect your cash and cash equivalents number. Let's get on the book, look at cash and cash equivalents, and then we'll come back and look at bank reconciliation statement. How do you reconcile the difference between cash in hand and cash at bank? On page 5, we're looking at cash and cash equivalents. So highlight cash equivalents. These are short-term, highly liquid investments that have both of the following characteristics. Number 1, they are readily convertible to cash. That means they are highly liquid. Number 2, they are so near to the maturity that they present insignificant risk of changes in value because of the changes in interest rates. Now, generally, only investments with an highlight original maturity of 3 months or less from the purchase date qualify to be cash equivalents. So this includes the third sub-bullet there: treasury bills, commercial paper, money market funds, and certificates of deposits with highlight original maturity of 3 months or less, as well as investments with a term greater than 3 months but highlight acquired from the open market when its remaining time to maturity is 3 months or less. So naturally, we are trying to exclude investments which have an original maturity of more than 90 days and, circle the and, purchased when the remaining time to maturity was also greater than 90 days. Now, when we are looking at cash which is lying in the bank, there would often be cases where the balance as per the bank statement does not tie into your balance as per your cash book. So the balance as per bank statement does not tie into your balance per books. In such cases, you got to reconcile these two balances. They need to be the same. So you got to reconcile them, you got to adjust them. And for this reconciliation, you prepare something what we call the bank reconciliation statement. So let us say we got balance per bank and balance per books. And I'll pick up numbers that we have on the example in the book. The balance per bank, let's say that's $8,100. And the balance per books, that's $10,700. These do not match. We need to reconcile these balances. Now, for reconciliation, we're going to have a lot of adjustments. And all the adjustments that we have in between here, we're going to divide that into two types. Type A adjustment and type B adjustment. Now, type A adjustment would be those items which the bank has missed out. The bank either is not aware of it or the bank is at fault. So guys, let us say you have deposited certain checks which are in transit. So you received checks from your accounts receivable from your customers and you deposited them into bank. But they are still in transit. They have not yet been cleared by the bank. On your cash book, you've already increased the balance, but the bank, they will not increase the balance till the time the check is cleared. So that becomes a deposit in transit. This is something which the bank statement is missing because the bankers, they would not have added this until it's cleared. How about, let's say, you've issued some checks to your vendors and your vendors have not yet deposited into their bank yet, or they have deposited but it's still in transit, it's not been cleared. So there are certain outstanding checks. Now you have reduced your book balance here because you issued out checks, you said the balance per bank has gone down. But the bank, they're not aware of it yet, or rather they will not reduce it till the time it's cleared. So this is something which the bank is missing. So this becomes type A adjustment. Now, there could be certain things which the cash book is missing, which you don't know about. Let's say the bank has charged a bank service charge and you don't even know that the bank has charged it. So on the bank statement, they've reduced it, but you don't know about it. So that is something which you are missing. So that comes as a type B adjustment. So we'll have a few type B adjustment. This is type A adjustments, type B adjustments. So it's a bank service charge. Let's say you received one of the checks from your customers, one of your receivables, and you deposited it into bank. And that check got returned due to non-sufficient fund at your customers or your receivables bank. Now you don't know about it. You're going to be getting it like, let's say, in a couple of days, but it's already been dishonored by the bank. So on your book, you've recorded it as if the bank balance has increased, but the bank, they know that it's been dishonored. You don't know. Your fault. You're missing it. Type B adjustment. Now, so we have identified all these items and we got the amounts on the book. Let's put the amounts right here. So for deposits in transit, it's $3,500 for outstanding checks. So this is $3,000. This is $500. This is $500. And bank service charge is 20. Non-sufficient fund is 80. Now the question is, do you add all this or subtract? Now for that, I'll give you a lovely trick, a lovely way of doing it. We'll use hand movements to understand whether to add these adjustments or subtract these adjustments. Now we'll do it in two steps. We'll call it step 1 and step 2. So we'll have step 1 and step 2. What we'll do is, we call it bank reconciliation statement. That sounds like bank is right. So your right hand is your bank hand The other hand, your left hand, that's your cash hand. So bank hand and cash hand. What you will do in step 1 is we'll move either the cash hand or the bank hand. So move bank hand, that's your right hand, or cash hand, that's your left hand. So you can do anything as per the requirements. Now as part of your step 2, you would check the reconciling direction of your hand, which is the starting point. Once again, you'll check the reconciling direction of your starting point hand. So let us say in this case, the bank hand, that is the starting point. So in step 2, you're going to be moving only the right hand, not the left hand. If you had been starting with this balance and going up, then you would have in step 2 moved the left hand, which is the cash hand. So in step 1, you could move the bank hand or the cash hand. In step 2, you would move, let's say when you're moving from bank balance to cash book balance. So bank balance to cash book balance, you're going to move only the bank hand. The bank hand is the right hand. So you're going to move only the right hand. When you're moving from cash balance, the balance per cash book, to your bank book or rather bank statement, then you move the cash hand. So guys, because we're moving from bank to cash, we're moving the bank hand. When you're moving from cash to bank, move the cash hand, which is your left hand. And all this may sound a little absurd to you, but let's do it here. So let us look at this first one, deposits in transit. Now, so this is my bank hand and my left hand, that's my cash hand. When I deposited a check into bank, in step 1, I increased my cash book because I received the check, I deposited, I increased my cash book. Cash hand is the left hand, so I increased my left hand, cash book. So that's my step 1. Now step 2, I'm going to look at the reconciling direction of the hand, which is the starting point. Which hand is my starting point here? I'm moving from bank to cash. So my starting point is my right hand. So what is the reconciling direction of my right hand so that both the hands come together, both the hands reconcile? Left hand has gone up, the cash book hand has gone up, the bank hand is below. What's the reconciling direction for this hand? Upwards. Up means add. So I'm going to add this amount. Let's look at the next one, outstanding checks. So I've issued out checks to my vendors, the bank doesn't know about it yet. So again, right hand is my bank hand, left hand is my cash hand. Now when I issued checks, I reduced my cash balance, the balance per cash book. Bank doesn't know about it. So that's step 1. Now in step 2, I'm going to be moving only the right hand. Right hand, does it have to go up or come down? Exactly, come down. My left hand had come down in step 1 because I had issued the check. Bank was not aware of it. Now when I'm adjusting the bank balance, I have to reduce the bank balance less. Let's look at the next one, bank service charge. So I have, again, right is my bank, left is my cash. Now the bank had some service charge on my bank statement which I was not aware of. So my right hand, the bank hand was reduced, bank statement balance was reduced, cash book I was not aware. Now I'm moving from bank to cash. What do I have to do? I can only move my right hand. I have to increase my right hand, add it, exactly, add it. Next one, non-sufficient fund check. Again, bank, cash. When a check was dishonored, the bank account reduced. The cash book, I was not aware of it. Now when I'm moving from bank to cash, which hand do I move? Right hand. And the reconciling direction is upwards, add. So these were items which the bank statement was missing. These were items which the cash book was missing. So now let's check if we can get to the right number. So 8,100 plus 3,000, that gives us 11,100 minus 500, that gives us 10,600. 10,600 plus 20 plus 80, amazing. That's 10,700. We have reconciled the balance per bank statement to the balance per cash book. So this is the balance per bank statement and this is the balance per cash book. Amazing, right? So we've moved hands, reconciled. Now this is format 2. Guys, if you realize, what is the number that you would want on your balance sheet? What's the right number? Is it 8,100? Is it 10,700? 8,100, this is as per the bank statement. Bank has been missing certain things. 10,700, this is as per cash book. Now the cash book also has been missing certain things. What's the right number that you want on the balance sheet? You would want this number, 10,600, to be coming in here. So you could do your bank reconciliation in another format, which is again pretty interesting. So you have format 1. And the way you'll do it is, you'll list down both the balance per bank statement and the balance per cash book. So let's get on the board there. So you have balance per bank statement and you have balance per cash book. So the balance per bank statement, that is 8,100. The balance per cash book, that's 10,700. Now on this, when you're moving out from balance per bank statement, you're going to put only the items which the bank is missing, or it's the banker's fault, type A items. So we're going to have type A items here. And when we're moving from cash book, we're going to have items that we have missed out, the cashiers have missed out, type B items here. And the number that we're going to be getting down here is going to be, so let's say the number that we're going to be getting down here is going to be adjusted bank balance, adjusted cash book balance. Let's do it. So you have deposit in transit. Is it type A or type B? The bank is missing. A bank does not know that we have made certain deposits and our balance need to be increased. They're going to increase it only after the checks get cleared. So you will have deposits in transit, that's type A. I'm going to come here. You have outstanding checks, again the bank is missing it, you're going to have it here. Bank service charge, we don't know that the bank has deducted some service charges, so we're going to get it here. A check has been dishonored, non-sufficient fund, NSF check, we don't know about. Again, our fault, type B adjustment. Now, once again, let's do our hand movement again. So let's put the numbers in first. So you have $3,000 for this, 500 for this, 20 and 80 out here. Now, when you're looking at when you're moving from bank statement towards cash book, cash balance, the right hand is the bank hand, left hand is the cash hand. Now, in step 1, you move either hand. So deposits in transit, cash hand increased, bank hand is as it is. Now, when I'm reconciling, I'm going to be moving this hand. In step 2, I'm going to moving only the right hand. It goes upwards, add. That's what we had here. Same thing. Same thing here. Outstanding checks, bank hand right, cash hand left, cash book hand left. Outstanding checks, issued out checks, cash book reduced. Bank doesn't know about it yet. So when I'm reconciling from the bank, go to reduce it less. Now let's look at those two items. Bank service charge. Now you had right is bank, left is cash. When I'm having a bank service charge, bank has gone down. So that is step 1. Now in step 2, in this case, I was moving from bank to cash or bank to books. Now in this case, I'm moving from cash to bank. Guys, you're getting it. Here I was moving from bank to cash. Here in this format, the other format, I'm moving from cash to bank. So again, when I'm looking at the bank service charge, right is bank, left is cash. Bank service charge, I reduce the right hand, bank gets reduced. Now in step 2, when I'm moving from cash to bank, I can only move the left hand. What do I do with the left hand to reconcile? Move it down. If I had done my right hand, I would have to move it up. So in this case, when I moved up my right hand, it was an add. In this case, when I'm moving from the cash, I got to bring it down. Guys, you're getting it. Here I'm moving from bank to cash. So step 1 in both this format, step 1 is right hand down, bank came down. Step 1 is same. Step 2 depends on whether I'm moving from bank to cash or cash to bank. Here I move from bank to cash. So in step 2, because I move from bank to cash, I move the bank hand, right hand upwards. In this case, because I'm moving from cash to bank, I'm going to be moving the left hand down. So I'm going to less. Non-sufficient fund check. Right is bank, left is cash. Check got dishonored. I'm not aware of it. So the bank got reduced. Step 1, same in both cases. In step 2, here I had moved my right hand because I moved from bank to cash. Now in this case, I'm moving from cash to bank. So I got to be moving my left hand. Left hand needs to move down. So less. Guys, if I do 8,100 plus 3,000 minus 500, 10,600. 10,700 minus 20 minus 80 gives me 10,600. I have reconciled. This is the correct number which goes into my balance sheet. So I moved from bank statement, corrected the bank number. I moved from cash book, corrected the cash book number. So these are the adjusted cash balance. So these are adjusted balances which I have reconciled. This is the same number that we have in the center in format 2. So you could realize, 8,100 plus 3,000 minus 500, 10,600. This part for me looks the same. Now when I look at this type B part, what I had done here was I had done 10,600 plus 20 plus 80, 10,700. There, what I've done in this case, what I've done is basically 10,700 minus 80 minus 20 gets me 10,600. That's what you've done, right? 10,700 minus 20 minus 80 gives us to 10,600, the correct number that we want to have on our financial statements. So you could do it in format 2 or format 1, whichever is good to you. If you're doing in format 1, the last numbers that you have here, that goes into your balance sheet. If you're doing format 2, the number in between, that's the adjusted balance, which goes into your balance sheet. So guys, remember this hand movement, very nice, very interesting. And I'll talk about a case or an incident which happened with me. So last week, I'd gone out to a date with one of my girlfriends from college. We went out to a posh discotheque downtown and she started moving so elegantly with the lovely music that we were having there. Now in class, I got a nerdy look and I'm so academic. So all you guys know here that Varun can't dance, and that's okay with me here. But there, I didn't want to let her have that image, that impression of me. So I went up to the dance floor and I recollected this class that we had on bank reconciliation statement and started jiving with these amazing moves, right hand, left hand. Guys, so make sure you remember all this. You do this very well, and trust me, this will certainly help you on Saturday nights getting dates even after you become a CPA. So right hand up, left hand up, right hand down, left hand down. Amazing, guys. All the best. Good luck. Good luck. On page 6, we are looking at the bank reconciliation statement. So right there, BRS by hand movement. So I've taught you how to jive away with the BRS. So right, step 1, move either hand as per problem. Step number 2, very important. If bank to cash, move bank hand. If cash to bank, move cash hand. So guys, once again, we're looking at BRS by hand movement. Step 1, move either hand as per problem. Step number 2, if you're moving from bank to cash, move the bank hand. If you're moving from cash to bank, move the cash hand. So guys, this is 1, 2, 1, 2, 1, 2, and I've taught you how to jive away BRS, the bank reconciliation statement. Now on this statement, you will have highlight 2 types of reconciling items. Highlight type A reconciling items not requiring adjustment on books, and highlight type B reconciling items which require adjustment on books. So let's look at type A and type B items on the example that we have on the bottom of this page. So I'm looking at the solution there. First, let's look at format 1, where we start with the balance per bank and we are getting to the adjusted cash balance. So the reconciling items here are actually type A items because they do not require any adjustment on our books. So put a bracket there and write type A. Then on the second part of format 1, we have balance per books and we are going to the adjusted cash balance. So these reconciling items require an adjustment on our books, and these are, put a bracket and write type B. Similarly, when we're looking at format 2, let's say we start with the balance per bank and we get to the adjusted cash balance first. So these reconciling items, put a bracket and write type A. And then from the adjusted cash balance, we try to reconcile that to our balance per books. So now these reconciling items, put a bracket, write type B.